Why have U.S. Treasury yields spiked dramatically over the last month? Well, U.S. two-year Treasury yields have shot up over 50 basis points in just over a month. The story had been simple prior to the rate spike. The Federal Reserve would begin an aggressive easing cycle to combat a coming recession. Then, around mid-January, everything seemed to change. Economic data came in hotter than expected, including the labor data on February 2nd, and the disinflation that we had seen for months appeared to reverse, igniting fears of a reacceleration. In recent days, though, the story seems to have changed again. Now, both Japan and the UK have slipped into technical recessions, causing increased concern over the global economy. Even bank stress has crept back into the headlines, with New York Community Bank rumored to be under stress. Now, of course, banking has been a concern for many of those predicting a recession after the incident with SVB Bank back in March of 2023. Now, the Fed now faces a very difficult task of balancing continued growth in many sectors with problems within the banking sector. So on February 29th, we see the latest reading of PCE, the Fed's favored inflation indicator, which could easily alter the current narrative. If a trader believes that two-year Treasury yields could continue higher from here, they could express that by buying the February micro two-year Treasury yield futures contract at 4.52 and target a move to the late November highs of 4.95. Now, a stop for this trade could be placed below at 4.20. This trade can make $430 if the target is reached and risks $320 if you're stopped out of your level. If a trader believes that yields could drop from here, they could sell the February micro two-year Treasury yield futures contract at 4.52 and target a move back to the cycle lows of 4.15. Now, a stop for this trade could be placed above at 4.82. This trade can make $370 if the target is reached and risks $300 if you're stopped out of your level.